Hello, everybody.
I feel like people have been remarkably on time for the last couple of these.
Since we started using the waiting rooms too, I noticed there is a software trickle in as well. It's not as instant as it was when we were just stalling for time.
Yeah, that helps.
But I think that's probably enough to get going.
Yeah, for sure. All right, everybody. Thanks for coming. Welcome to Startup Formation, Equity, and Early Legal. It's been a while since Ryan and I have done this one. We're excited to do it again as part of our founder curriculum, specifically our founder launch curriculum, which is meant to hit all of the topics you really need when you're taking an idea and really turning it into a startup. So today we're going to focus all around actually incorporating a company, what that means, when you should do it, why you do it, and the mistakes that people often make. Psyched to have Ryan doing this one. Ryan is the COO of Gust, which you probably know. My name is Peter Swan. I'm the CEO of Gust. So we'll be kind of ping-ponging this discussion. If you do have questions as we go through, feel free to plop them in the Q&A. Feel free to chat in the chat. I will interject questions as we go when they're topical, and we'll have some time at the end to get to stuff that we didn't get to through the presentation. We will record this presentation and send it out usually a day or two afterwards, so don't sweat that. And with that, I will hand it over to Ryan.
Awesome. Well, I'm happy to be back doing this one. We've done so much programming with our partners over the last couple of months that it's fun to remember that we have our own content as well. So this is usually what we lead with, but this is all the considerations around really going from 0 to 1 and starting a company. And we're going to walk through a little bit of the decision factor about which kind of entity, but then go deep into Delaware C Corp's high-tech startups or high-growth startups, because that's what we specialize in. If you're even before that, we did a whole prepare series in December that actually addresses, if you're earlier than that, you're not ready to start an entity, and we'll send out materials with the follow-up linking to both of those curriculums to help everybody out. I believe we have the chat open up, so feel free to say what your startup's name and where you're coming from. Don't pitch us. We're not going for investment, but just to share with your fellow founders. And let's get to it. So normally we do this presentation bright and plucky, but we're doing a spooky edition that we did for Halloween once, and then it just was kind of fun enough and it had a theme enough that we're sticking with it. So pardon any cheesiness here, but it's more fun for me. So why would we even care about all this stuff? When you hear about starting a startup, it's like building a product, doing market validation, talking to 100 customers, like all the kind of sexy stuff you read about in books. The lean startup, the 0 to 1, is about your customers and engaging it. So why would you care about corporate structures and equities and stuff when you're just getting started? Well, honestly, the more of these little mistakes you make, the more complex and expensive it can be to clean up your company when things go well. If anybody's started a startup before, I'm sure they realize like it is incredibly uncertain. Your business model, your market, your founding team, the macro climate, the microclimate, all these things are bets and uncertain. And you constantly change what you're doing. So if you don't keep yourself in decent shape, though, you can really be overwhelmed by simple little early mistakes. And the costs of fixing them are sometimes more than the runway that the company has left by the time they get a good signal, whether that's investor interest, early customers, or something like that. So let's avoid that. Let's find a nice fine line between way too much conservative, paranoid preparation and way too cavalier, move fast and break things, including your company. We will say we run a platform that helps people avoid this by basically doing that just enough preparation and having helpful legal workflows and education to get yourself set up and avoid mistakes. We call ourselves a legal tech SaaS platform or a company as a service. And a lot of our features and the way we built Gust Launch is to help companies avoid this. However, before we sell our wares all the time, let's actually talk about, what is the gotchas that you could run into, how to keep your early baby corporations surviving so you can eventually thrive when the good stuff starts to happen. All right, so backing that up to why would I need a legal entity in the first place? There's 3 real core reasons behind this. The big one is limiting your personal liability. We're talking about the United States here. United States business entities are separate from the people who started them and founding them. So what you don't want to happen is if you take the risk, you go off on a new venture, things don't work out. Statistically, they're probably not going to work out. So people try multiple times, but the last thing you want to do is lose your shirt, lose your house, because some mistakes that the corporation made have bled into your personal liability and the company was being sued, but now you're actually being sued. The nicer reasons why we need a legal entity are, collecting all the ownership of the assets and IP into something other than you as a person. That means it's something that's sellable, it's something acquirable, it's something you can go public with. That's actually how you create wealth as a founder, is when you eventually sell the company or get acquired or IP, your shares are worth something and they're holding the value of that. It's not you as an individual. And then on the day-to-day, entities actually have a lot of meaningfully and well designed over time structure that helps multiple parties collaborate and build value together, whether this is investors, the co-founders, contractors, and advisors. There's a set of structures and rules that actually makes a reasonable amount of sense to do business rather than just doing it, on arbitrarily handshake deals or, vague understandings of what other party wants. So throughout this presentation, we have what's called ghost stories, which I find it really helps ground things that are very abstract into real world examples. These are all made up, but we're going to walk through a number of these to illustrate some of these concepts and how they play out in reality. So this first one here is the idea of somebody working on a side project, not even worrying about a legal entity. They talk to a couple people and they say, hey, I like this project you're doing. I could see something in there, but they're not, angel investors or traditional investors, but they give a, couple tens of thousands of dollars to one. He spends the money, builds a website, builds an app, gets things into the app store, tries to work with people. It just doesn't work out though. It doesn't go anywhere. And now these investors, unfamiliar with these investors, which we'll get into a whole different thing of what a real investor is, but they didn't realize that this was a very low chance effort. They don't have a portfolio strategy. They're upset that that money went away and nothing ever happened. So they sue, but there's no one to sue but Juan because he doesn't have an entity. So now Juan is personally going up against, a lawsuit from Spurn investors rather than having a legal entity that could go bankrupt. But if it goes bankrupt, Juan doesn't go bankrupt, just the entity. So you want to be sure, rest in peace, not your company, but you. All right, the chat's going crazy.
Opposite, right? Rest in peace, your company, not you.
There we go. So knowing why we want one, when should you actually form a legal entity? The biggest forcing factor is when you have to. The most common things we see is somebody tries to get an app in the app store and they're asking for a DMB number, an EIN, or they're trying to get a bank account. And it's like, what is that? That's a tax ID for a company. You need to set up a new company in order to get one of those. Or something is pushing you. You want a business plan competition and who do we write the check to? They're not going to write it to you as an individual. They'll want to write it to a business entity. When it's not a forcing factor, our advice is honestly when you could afford to, depending on your cash needs and cash strappedness. As soon as you're getting more than one party involved in a company, it's a lot safer to have an entity that is doing the business rather than confuse things and have vague understandings of what might happen in the future. If you have, Gus launches $300, if that's not a big deal to you, setting up an entity, if you're going to earnestly pursue something, will probably avoid you a lot of pain and risk in the future and clarify a lot of these early business dealings that can often be very vague. If you're a little cash strapped and even that isn't enough to afford to, and you really want to see, hey, I'm not going to do this, unless I'm reasonably sure it's going to work out, or there's some signals I think I can get in the market before I even want to, spend time doing that. We say when there's significant value at risk that you're worried if something went bad, you would lose out on it or suffer personally. So things like having customers, building out a team, hiring contractors, working with, development agencies or shops, obviously getting investors, or bringing other people into it. If you're just you and a solo founder, you can probably market validate on your own before really setting up an entity. But if you have a co-founder, the clarity of the conversation around how much equity does each person have, having them sign IP agreements so that everything that they work on is owned by the company, not themselves, really helps save that value, that's risk, so that you're confident that the company will grow with the efforts that you're putting behind it. All right, so what kind of entity to start? The big question we get all the time, LLCs versus C Corp. We're going to quickly go through LLC because it comes up all the time and it's so easy. And I feel like there's just market wins that get people signing up LLCs for whatever reasons, but then we're going to deep dive into startups and C Corps. So an LLC is exactly what we talked about in the liability section of this, of why you'd want an entity. It's a limited liability company. If you're acting on your own and just doing business, the United States basically says, oh, you're like an unincorporated entity, but you're a person, it's you. Setting up an LLC is a way to actually have an entity who's doing the business, but it's pretty lightweight. They're fairly cheap to file in your local state. Most commonly, all of the economic activity just passes through to you when you do your own income taxes. So you don't have to worry about, filing corporate taxes and the corporation being taxed separately and salaries and whatnot. Often they can be lightweight structures for one or more people to just do work together. However, there's no concepts of shares or fractional ownership. Everybody has their own operating agreement and they can be very different. And the biggest thing that we, in the investable high growth startup world is professional or institutional investors will not typically invest in LLCs. They're just too custom. They don't have the faith that, the fractional ownership that they're looking for is actually going to be enforceable. Specifically, Delaware is a company that has C Corps that investors prefer, literally because the body of case law is so vast for them that it gives investors confidence that when they give you money today, if things go well tomorrow, they will actually be able to reasonably cash out. So let's jump into a C Corp. So the C Corp, the C just comes from the subchapter of the IRS. Took me forever to find that out. So it's not some alliterative or strange name. It is the most common type of corporation. There's one in all 50 states. They have some version of C Corp, but like I said, Delaware is like miles and miles ahead of all the other states in terms of just the sheer body of case law and corporate friendly courts that they have. C Corps come with shares. A lot of us are familiar with shares from the stock market, public stocks. It's a bit more complicated in the private space, but it is that what we call fractional ownership that allows investors and the founders to share in the upside of an eventual sale, acquisition, or IPO. And there's some specialty to this is there's a lot of tax advantages for owning specifically shares in a C Corp. I'll get into this more details later, but one specifically is QSB-HES, which entitles both the founders and potentially investors to write off up to $10 million of gains in that eventual sale, which is incredibly something that professional investors think about a lot if they're investing in tens, if not dozens, if not hundreds of companies over the course of a long investment time horizon. They do get taxed differently, though. You will often hear C Corps are double taxed, which is the corporation at the end of the year files taxes for whatever profits it makes, as well as it pays taxes on salaries that it pays out and things like that. However, oftentimes that's a red herring to scare founders away from C Corps because the kinds of companies we're talking about, high growth startups, generally are not being ultra profitable entities for a very long time. They're actually reinvesting the profits into their business to scale and grow, or they're raising capital so much so that they don't have meaningful corporate profits for a long time. So they're not actually paying, out the nose every tax season. There's some additional complexities where you can have multiple share types for organizations and mirror a lot of, complicated ownership situations, which create very fun, dramatic movies and television shows about early stage founder stuff, but we'll get into the details of that as we dig in a little bit more. And so the biggest question we get all the time is, okay, a C Corp, it's a little bit more complicated, but like an LLC seems really easy and really cheap. Why wouldn't I just do one and then switch to the other? And the answer is you can. It's just often far more costly to do it simply and then later have to convert it. So here's an example. Somebody starts an LLC. It's just a local with their state. They go and find a lawyer, not startup familiar law firm, just somebody who helps with business and contracts and things like that. And so they get this custom operating agreement. They're thinking they're building a software company, right? They're building a web app, they're building a software as a service thing. So they hire a dev shop to build some stuff out. They bring on a co-founder and say, hey, yeah, we'll split this 50-50, but there's no provisions in the operating agreement or really notion of that. So it's just, what they've agreed to. But that dev shop actually produced something. They start getting investor interest, super good signals, right? The investor politely informs them, like, I don't invest in LLCs, but like, are you going to be a C Corp? So they go back to the lawyer and realize like, oh, now we have to figure out, well, what was that relationship with the co-founder? Oh, we signed an agreement with the dev shop. Like, oh, we've actually had a bank account under a different EIN. That all requires legal and accounting work that fixes that up. And these are, in the hundreds, if not thousands of dollars hour kind of billing stuff. And then, but raising from that investor who finally likes the way your, house is in order and you're stitched up and you're a good C Corp. If you've spent 20K of what that small raise was, like that's a significant runway hit. That could be months, if not a half year worth of, the lean times that you just spent switching entities, when in reality, the difference between starting with a C Corp and an LLC was probably like $100 if you did it the first way. All right. And the question we always get, and I know I had one in advance, is international existing entity options. So you can start a C Corp from pretty much anywhere. Delaware will love to have you pay franchise tax for the duration of your corporate existence. There's just a little bit of delays and hitches if you aren't a US citizen. So if you have a social security number, US citizen, generally things just move faster. Your corporation comes out of Delaware in 2 to 3 days, your EIN comes at the same time. Setting up banking is a bit easier. You can set one up as a founder from somewhere else. You don't even have to live in the United States in order to set up a corporation. But your EIN is going to be a couple weeks. A couple other processes might come up just because there's not as much evidence in the databases and whatnot to smooth things along. However, it is very common for international people to set up to try to get exposure to the US market, US investors. And we have other programming events, we can talk about that. If you already have an existing entity, even if it's domestic, if it's in one of the 50 states of the United States, there are ways that you can convert. The easiest way is honestly just to dissolve it. If there was nothing really of value, if it was a single person LLC, you made some stuff and you realize like, hey, I need a C Corp. If you just wind it down, own all the property yourself, and then put it all into the new C Corp, that can often be the cheapest and the least and the most clear way to do it. However, like that example we had from before, if you had built something of value and you've created value and captured it into the company, it might not be as easy to dissolve it. There might be multiple people in the company, and how that would be handled might be a little more complex. Or more often than not, you might want to keep the LLC running because it has like a services line of business where you discovered a product out of it that you want to go and run more as a high growth company. So there's a couple options. There's something called statutory merger in about half or a little bit more of the states that make this somewhat straightforward. You'll probably work with a law firm to come up with a plan of conversion, but you file that at the same time as you start the new C Corp. It's a little bit more straightforward. Outside of that, there's mergers, there's non-statutory mergers and conversion, there's creative relationships between the two entities if they're going to live. All of those, generally, you should consult with a lawyer. So it means they will be more pricey, but hopefully, if you have something that you want to, persist, it means that there's another business line there and it could justify that expense. And the last thing about entity formations, S-Corps, benefit corporations, you hear a bunch of other things. S-Corp is not an entity type. It's actually a tax election that a C Corp can take to be treated more like an LLC, that pass-through taxation that I talked about before, where it just goes onto your personal income tax. LLCs can also take S-Corp elections, so people get very confused. They'll often find an LLC and then do an S-Corp election and call themselves an S-Corp, but really it's just a choice, and you can make that choice yearly when you file your taxes. Big warning for any high growth oriented people going after kind of professional money or venture capital. There is a little bit of vagueness in the space of doing S-Corp elections as a C Corp, as it could possibly complicate your QSBS status. There's a very specific law on the books that says a company has to be filing as a C Corp for sufficiently all of the holding period of those shares in order for them to qualify. And there's just not enough precedent to say what that actually means. So most people who are going after high growth just play it safe and stay as a C Corp, and they don't bother with S-Corp filings, because if it complicates QSBS, that's really bad in comparison to maybe like a tiny bit of tax savings, getting started up. B Corp, similarly, is a public benefit corporation. It is very, very similar to C Corp in terms of all like the bylaws and the operating procedures, the layers of governance. However, they are allowed to have something on their charter that allows them to make decisions beyond just enhancing shareholder value. You might have seen this has been more popular in the last decade or so. Companies like Tom's and various things who have a social good mission tied also with being a profitable company. It doesn't have to be a this or that. You don't have to start as a B Corp in order to be a B Corp. You can actually get B Corp designated while staying a C Corp. So in the early days, we usually say don't stress about it too much. It could be an asset, to your business model, pitching to investors, impact-oriented investors, and things like that. But it's usually how your company is going to run that is more of the asset than the specific designation. And like I said, you can go and get it later or change it. And Pete loves B. We all love B Corps. So those are kind of the surface area of the entity types. But now we're going to deep dive into, all right, so you've chosen a Delaware C Corp. You want to do a high growth startup, a tech oriented startup. The three questions we always say is like, if you're going to do one of any of these, is raise money from professional investors, that's angels, VCs, and anywhere in between. Incentivize your employees with stock option plans as your company grows, or the eventual end game for your company is either an IPO or an M&A or a substantial private company. If you say yes to any of those questions, we generally advise a Delaware C Corp is probably for you. So setting it up, simple filing with the state of Delaware. That's going to create what's called your COI, which is usually in the beginning, a single page document that just kind of lays out the name of the corporation, the address of the person who incorporated it, a little bit of liability projection, and importantly, how many shares it has authorized in the state and what they're valued at. Ours default, and the rather, tens of millions is the default, mostly across the startup industry. All of our launch companies start with 10 million authorized shares with a par value of 0.00001, which means that those shares are like 1/10 millionth. They're very cheap to buy, and the company starts almost worthless, just a small amount of overall value there. Once you get that filing back, you're not done yet. That's just the COI saying now you own that name in Delaware. You need to establish the bylaws and basically set up governance. So governance is electing bylaws, which is this is how we make decisions. They're not super custom. You can't just create your own bylaws. Often they have to refer to Delaware corporate law and what you can and can't do. There's some configuration, and a product like Gus Launch, all of our bylaws are super straightforward, kind of industry standard. Nobody changes or wants to change any of them, but it's things like how you can do consent without having an in-person meeting, or setting up, being able to do things online and store documents online. All those things kind of come up. So once you have the bylaws, that will give you the provisions to appoint the board, as well as to appoint the officers and adopt stock grant documentation, actually start issuing some of those authorized shares. I'd be very specific when I say authorized shares in Delaware. It does not mean that the company immediately has 10 million outstanding shares, and that's the denominator of ownership. That just means in Delaware, you can't issue more than 10 million shares. You've just basically put a high watermark with the state that says this company will not issue more than 10 million shares. So when you issue shares to the founding team, you generally leave yourself some room. We advise issuing between 6 and 8 million shares to the founding team, depending on how certain you are that that is the fixed founding team. And veer towards 6 if it's you're looking for a co-founder. Veer more towards 8 if you're pretty settled. But once you get those layers in place, that is establishing governance. You have officers, you have directors, and you have shareholders. You are now have what they call fully established the corporate veil. So you are now a real Delaware C Corp with the liability protections inherent in that entity structure. So that's getting you all set up in Delaware. The last thing you want to look at is if you don't live in the beautiful state of Delaware and you're going to be operating out of another state, like the beautiful state of New Jersey, where I happen to be, or Tennessee, where Pete is, you will want to file a business registration in that state. This is often called forward qualification or authority to operate or something like that. Every state has a slightly different one. They're usually a couple $100. And what that's basically saying is you're going to be operating out of here. Some states have a franchise tax of their own. That's an annual thing. Some states have, biannual reporting requirements. I know we're based in New York, so we have to file a report every 2 years. That costs us $9. California, it's every year. It costs you $800 after the first year. Every state varies a little bit. And it's worth poking around the Department of State website to figure that out, especially if you have multiple choices of address, depending on your life situation. So as you can see, I'm running out of breath. It's like, do I really have to set all this stuff up? Like, what are the downsides? Like, I feel like I can build an app. I can work on things, and if it doesn't work out, it doesn't work out. So here's an example of somebody who's doing most of it right. So starting out with Delaware C Corp, Jack creates a Delaware C Corp, knows what he wants to do, has listened to me ramble on about, finer points of entity differences, appoints himself a director, and doesn't really do anything after that because he's not really sure. So he's like, I'm the director. Cool, I got a company. I'm going to go run it. Doesn't realize he needs to file foreign qualification. Because he's like, I'm a Delaware corporation. Why care? I live in New Mexico. And they kick it off, starts making good revenue, captures value, brands out there, it's getting customers. Once things have reached a tipping point, it's like, all right, I can finally afford, an accountant and do my books and make sure everything's cleaned up. Doesn't realize, like, based on when he incorporated, like, he's actually owing back taxes and there's fees and there's interest and the things have piled up. Worst case scenario, he might have never filed his reports and his company is now out of good standing and he has to pay a revival fee and like back taxes on that. And while he's managing all that stuff, some vendor relationship goes sour, the company gets sued. And this is imaginary, crazy litigation time, but in the lawsuit, it realized like, oh, you were just a director. There was no shareholders. There was no officers. You were just acting on your own. Well, that's actually a shell company. You never established the corporate veil. So like our previous example with Juan, it's possible that lawsuit could bleed into him personally. Nobody wants that. Oh, and I did see a chat on thoughts on LegalZoom for setup. And this is an example is a good one to pull out is often if you're just relying on like little bits of templates to do parts of these things, you can string together like 80% of what's going on. But if it's not all stitched together, there's still like leakages in place that could pop out. So I know with like LegalZoom, you can, well, the UX pattern of trying to actually buy just a corporation out of LegalZoom is quite fraught with a lot of upsells. But if you manage to just do that, you might be in a position where you don't have the templates to continue to form the rest of the entity. Or you might have only had just a single directorship, or somebody else is actually the incorporator of the company that works at LegalZoom, and you don't have the right things in place to do this afterwards. You can get it done. There's tons of services out there that do transactional filing. Our particular thing is really about startups to get this all right because it's not really a custom path for that initial corporate setup.
Yeah, and I think generally that is a suggestion that we have is regardless of whether you use a legal tech service or you work with lawyers and accountants to do this stuff, it is a very good idea to work with people who have a startup focus and have experience working with technology startups. Because while the bones are the same, there is setup that is custom to a corporation that is formed with the intent of raising money and eventually going public. There are specific tax advantages like QSBS. There are things that your lawyer and accountant should put into your formation documents and should put into your governance documents that set you up to have a smooth fundraising process. So using a startup focused provider will get you somebody who is familiar with all of those idiosyncrasies and trying to kind of coordinate and orchestrate those idiosyncrasies yourself on a more general legal tech platform is pretty difficult to do.
Yeah, and I think often a lot of services, the phrase is like giving you enough rope to hang yourself, where they allow you a level of configuration where if you don't know the whole picture, you end up doing seemingly reasonable decisions up front that are very costly later. I think we have an example later about issuing or authorizing a very small amount of shares because it seems like there's a tax advantage to it and you'll save on near-term fees when the long-term it's going to be a much bigger pain in the butt. I think we'll get into that next slide. All right. So the common stock. Now we talked briefly about issuing stock to the shareholders, but what actually goes into both the consideration and the conversation and the actual execution. Put this in bold because it's very important. Having a discussion about the equity split between co-founders, if there are co-founders, is exceptionally important. And the earlier you can have productive conversations around this, the more pain you can save yourself in the future. There's no good industry stats on this, but founder infighting and misunderstandings is probably one of the leading causes of early startup failure. Just not understanding who's putting the same level of efforts to the business and what it's going to require. We actually built a tool around this because it's common enough called the co-founder equity split tool. It's a interactive survey that both all members of the founding team can take, and it will give them, weighting against each other, the results of what a recommended split is for that founding team based on, 100 different dimensions of value add. So things like who's going full time, who's putting their own money into this thing, whose domain experience is absolutely essential for this to succeed, who has worked in startups before, who has a network, who's doing the pitching. It's 60 other questions that'll really help inform the conversation. I wouldn't say take the numbers that pop out of that and just immediately go into Gus launch and issue those shares, but the nature of the conversation will really start to kind of break down the barriers and get founders on the same page so that they can have a meaningful conversation about how much should somebody actually own of the company. And the big thing is, even if you get through that conversation, if you had a handshake deal, if somebody sent you an email that said, okay, we're going to be 60-40 or 50-50, that's not the same as issuing. Real equity issuance needs signed documents that map to an actual stock plan that the company has. So agreements, and often I see this a lot of times, is people go and download an agreement that's like an advisor agreement or like a lightweight agreement that just promises like, oh, and you'll have 2 million shares. But without what those shares are, what class of shares those are, what the shareholder agreement is, what the stock purchase agreement is, that is a very lightweight way to get yourself in trouble. You want to have real stock agreements to establish this ownership. When you start out with common stock, these are real ownership voting shares. So it's not, a lot of people are familiar with stock options from later stage tech companies, which is the right, but not the obligation to buy a share. When you issue common stock, the ownership is immediate. So the voting rights, once the share grant is complete, will be transferred or given to the co-founder. Like I said before, we emphasize leaving some room, that 6 to 8 million. If you have a max of 10 million in Delaware, issuing 6 to 8 million, depending on how certain you are on your founding team and what your future is, gives you some room for all sorts of things. If a co-founder leaves and you buy back most of their shares, but you get a new co-founder that's in a different role with a different share count. Later on, if you do adopt an equity incentive plan, it's great if you don't have to go back to the state of Delaware and pay a bunch of money to file an amendment to amend the COI. So giving yourself that 2 to 4 million envelope will allow for a lot of flexibility in the future. And really driving home the point is, don't worry so much about the 10 million number as the denominator. It's only what you've issued at any given moment in time that determines ownership. So if Pete and I started a company and I issued him 1 share, he's 100% over the company. If I issue myself 1 share, I am now 50% of the company, and Pete is 50% owner because he just got diluted because the denominator is now 2 shares. Never do that. Never issue very, very small amounts because it trips up a tax calculation. You want to be in the 5 of millions or so. But that's how ownership works, in shares in general. So a lot of people fixate around maybe that 10 million sometime. A company can go all the way up to the preferred round with only 7 and change issued. And that's totally fine because the ownership percentage is what's really meaningful. You own a certain percent of a company that's worth a certain value. Whether that's determined with 4 million shares or 5 million shares or 3 million shares is less relevant to the percentage and the overall company value. Common stock is almost always used for the founders. Some early team members get common stock grants as well. The most common ones are advisors, contractors, possibly early employees, if you're fortunate enough to be able to hire employees when things are really early. Those are smaller share grants for the most part. I think we actually get into details on that a little bit. Common stock is rarely actually sold to investors. And this is a real tipping point for a lot of people. We're like, okay, so like I'm going to give myself 5 million shares. What do I do? Sell 2 million shares to raise money? Almost never. Common stock is rarely ever sold to investors because in the early days, the company is worth very little. And honestly, a lot of times that is validated. There's not a lot of revenue. There's not a lot of customers. What founders are often pitching investors on is the future potential value of the company combined with the traction so far, the founding team, the market, their own investment portfolio, and where they think this company could go if things go well. So when you're usually raising funding from investors, you're actually talking about a valuation negotiation that is for a different class of stock. Most often that is called preferred shares, and that is new shares that you create that are different from the common shares. This is kind of how fundraising worked in the late 90s and into the 2000s, where you would work with investors, you would negotiate a value of the company that's packed in a bit of the future promise. Say it's $9 million. We think this company is worth $9 million right now. We're willing to give $1 million to this company because we want 10% ownership of it. And if I take a $9 million company and I give them $1 million, it's now a $10 million company. And since I have $1 million of those dollars, I own 10% as the investor. Everybody agrees that that's the value of the company. You go to Delaware and you say, okay, we're going to create a new share class called preferred stock that I'm going to sell to the investors. And I can sell it to the investors for this millions of dollars because of all the terms on that preferred stock that give the investors protections. The biggest protection, preference. They're the first ones out. So even if the company sells at a lower value later, they're paid out first before the founders are. And there's a bunch of other micro terms in those things that allow you to sell those shares off to investors for a higher value than what the common is often worth. More recently, to pull in smaller amounts of seed or pre-seed capital, we have some instruments called safes and convertible notes. Probably a lot of people have heard of them. That is a means to kind of a faster way to raise capital when things are really uncertain by deferring the intense negotiation of preferred shares into a more promise for future equity. So SAFE literally stands for Simple Agreement for Future Equity. Convertible note is a convertible note that converts into preferred equity. And what those do is they simplify the terms so that you can get early money in when things are more uncertain, and then later on figure out what the ownership is going to be when you create that preferred round when you raise more money. Back to grants. So almost all grants should have vesting, even to your founding team. Even if you're a solo founder and you think like there's no way this business doesn't exist without me if I leave it, whatever, the first touch with investors are going to want you to put vesting on it anyway, and amending things is always more expensive than doing right in the first place. What vesting is, like I said before, is ownership is immediate. So you have the voting rights, inherent in the share accounts that you got. But vesting on common stock, different from stock option vesting, is the right for the company to repurchase your shares in the event that you leave the company for whatever reason. And so all co-founders should have this, any advisors, any contractors or team members or anything like that. As much as you would want to be certain about the composition of your founding team or yourself, stuff happens, life happens, amiable things happen, people have life events, things just don't work out. So it's very, very complex to transfer stock between people in a private company. Has all sorts of tax implications. It can blow tax statuses like QSBS, what we talked about. There's also income issues and company value things that you want to avoid. So as much as you can avoid transferring shares around or buying and selling in a private company, it has all sorts of downsides. Vesting helps clean that up, which is basically you give somebody a share grant with a reasonable vesting schedule. The most common one for founders is a 4-year vesting schedule with a 12-month cliff, which means that they will fully own all of their shares after 4 years have passed. And the first year, they don't fully own those shares until the inflection point of the first year, which is basically kind of like the getting to know you time, where you're really certain that you're in this for the long haul. It's so that you don't have micro pieces of your company just irrevocably tied up in small owners that didn't work out after a month or two. So be sure you put sane vesting schedules. Most common for founders is, like I said, 4 years, 12-month cliff. Other kinds of team members, an advisor is pretty commonly 2 years with a 3-month cliff. But look at the relationship. If somebody's not going to start full time for a bit, you might extend the cliff. If you're working with a contractor and you're giving them some equity, for some upside for, below market rates, and you all agree to try to ship an MVP by 6 months, maybe set your cliff 8 months or something, that you will at least be able to know that the relationship is working out and that the company can instantly repurchase those shares should that relationship end, go sour for whatever reason. The company buys it all back at the same price that it was issued. It's the easiest way to maintain ownership of your shares. And lastly, uncommon, if you're a US citizen or US taxpayer rather, so SSN or ITIN, or if you feel like you might end up being a US taxpayer in any part of the duration of your vesting schedule, you should probably file an 83B. An 83B election is something between you and the IRS as a private citizen, a personal individual. It's not actually necessarily what the company files. But what an 83B says is, hey, I have this stock grant that has vesting that goes out 4 years. The IRS says, oh, great. So like, you don't really own those things until the entire 4 years have passed. Every month that you vest more, we're going to treat that as a taxable event. That's a bad thing when your company starts growing in value, because in 3 years from now, if your company is growing substantially in value and you're still vesting those shares, you'll be taking income tax hits for a much more valuable company and much more valuable shares. So what the 83B says to the IRS is like, hey, I'm going to take that income tax hit all up front. And it turns out that is zero because you just paid for the shares that you just issued yourself. And so you're clean and you won't have to worry about vesting triggering income events in the future. It's almost always a good idea if, one, you're going to be a US taxpayer in any part of that window, and two, you think the value of those shares are going to appreciably grow. And usually if these are founder shares, these are brand new shares in a company that has no assets. So they're almost worthless. So the only way is up. The only way you'd probably not want to do that is a much later stage company that for some reason is still granting common stock out. And there's the potential that the company could decrease in value because part of the 83B election is giving up the ability to take a loss in case the value goes down. All right, how am I doing on time? Not too bad.
You've got
so here's
about 3 minutes, 3 to 8 minutes.
So here's an example, kind of what I talked about before with wrong share counts. So this is like if you're using a choose your own adventure, put in whatever values in our templates we want, and we'll file it with Delaware sort of service. So you start out with a C Corp. You only authorize 500 shares at a pretty high par value, $100th of a dollar each or a tenth. Grants 300 to themselves, 180 to a co-founder with no vesting because there's no way these guys are ever going to break up. Then they break up. There's no means to buy back the shares from the investor, but they just come up with an agreement that they buy them out. So they actually pay money for them the shares, and it's a little bit more than before because some time had gone past and they were just kind of eyeballing it. Little do they know that those shares that got repurchased have lost their QSBS status. So they're unappealing shares for investors or future team members. This person's going on solo, they find a contracting firm, and they realize like, oh, we can't grant them stock. We don't have enough stock to grant with proper vesting because, we only have so few shares that we can't vest over 4 years, if, it's only 10 shares or something like that. Finally learns, oh, they have to file an amendment with Delaware. So they bump their share count, but they don't realize they should have bumped their par value as well. So now they're asking the contractor team to pay $50K for a 5% share in the company because those shares are still very valuable. Of course, they can go back to Delaware and amend it again, but there's filing, got to get legal work to get the board actions and the shareholder actions up. And all this amounts into like, finally, you're getting investor interest, but the investors are looking at the capital structure of the company and they're like, what? Like, you bought back shares at one point and the company was worth this much values? How did that change? It's only been 6 months. And then, oh wait, what's the QSBS status on this? The whole thing just introduces friction and unnecessary expenses. Okay, we're almost here. So that's kind of most of the setup that you want to get. So you've got filed in Delaware, you've got shareholders, you've got a board of directors, you've got officers, you've distributed meaningful shares to your co-founders. You've had the good conversation about it, and you filed your 83B elections. You're pretty much set up to actually start to build value in your company, and the company will capture it, and you can have those conversations, and any sort of good things that happen from investors or possibly teammates, you have answers for in terms of what the corporate setup is, all the things that you've signed. So how does your company actually appreciate in value? Money is a big thing. So literally money in the bank. If you get revenues, if you're doing contracts and things like that, anything you create that's intellectual property. It's a little bit more nebulous of how much intellectual property is worth. If you build a big code base and it generates a ton of revenue, you can in your brain think, well, it seems like it's going to continue doing that. So there's maybe a revenue multiple in there that makes a lot of sense. your team itself and the composition of your team, your experience, how you work together. You will often hear investors say a well-running team is one of the biggest differentiating signals between the companies they invest in and not. So people who've worked together in the past, people who have a certain expertise or something like that, there's a value add to that, sometimes greater than what their market salary rate would be because of specialized domain knowledge or just the ability to work well together. For more traditional businesses, equipment, machines, warehouses, assets, inventory, things like that. And then this kind of the other side of building intellectual property or, acquiring assets and machines is the customers' contracts and orders. People who are signed up for multi-year contracts, annual contracts, even if it's month to month, all those things push value into your company over time. And the more those things sing together as a narrative that value is going to grow and continue to grow, the higher that valuation that you negotiate with investor could be when raising funds. So as you're taking this fun and exciting journey and finding that you are, creating value in your company, the biggest thing is you want to protect it so that no, outsized event can happen that will blow away all that hard work, because it is hard work to create even small amounts of value and successfully capture it. If you attended the Vouch event that kicked off this thing, there's a whole lot about protections that you can do in terms of insurance as you create value. That's a whole other consideration as your company grows. But when it's talk about capturing the value and we're talking about entity formation, is like, that's how you really make sure that the organizational value is sort of bulletproof. So fully establish that corporate veil. Be sure that all the people working for the company are contributing IP to the company. There's no lack of clarity over, who is actually owners of that kind of IP. Keep your personal finances separate. Ensure that anybody else who is helping out is going to both send their IP to the company as well as protect it. So in almost any of the agreement, don't go crazy with NDAs. Other agreements like contractors and advisors have NDA provisions in them that you can't go and like leak company secrets or do compete kind of things like that. NDAs are generally just for vendors, but be sure whatever relationship you have with somebody, if they're an advisor, a contractor, an early employee, a vendor, there's an agreement signed somewhere that protects the company in case the exchange of business or the transactions between those parties goes awry. Be sure your equity grants are legit. They're not just handshake deals. They're board approved, they're granted, they have good vesting schedules, and keep everything together, generally on a cap table. All these paper that you're signing are slowly building your capitalization table, which is who owns what of what shares under what terms of the company. So, all right, I did this in an okay amount of time. I know that
we got lots of questions though.
That probably seems like a lot. I'm talking myself dry over here, and yeah, it is, and this is why we exist. So Gus Launch is basically the majority, 90% of these kind of considerations streamlined into a fairly easy contextually heavy experience that allows you to, we call it sort of guardrails on the infinite decision making that you could do when setting up and running a business. They're generous guardrails, which will kind of nudge you in the right directions. They will answer. You can see this example video playing. We have a lot of this right rail help that we use is to really just let startup founders focus on their business and have some confidence that they're executing common contracts with the smart defaults. And that, if they have to go off of those defaults, they're doing so with full knowledge of the ramifications of them. So we have all these agreements that you see here: incorporation, IP assignment. We literally print out your 83B election, tell you the address to send it to, advise you to use a self-addressed stamped envelope like you're doing a cereal box thing. We have bank account integration, NDAs, all the agreements, and we even have fundraising instruments like safes and convertible notes. So when you get up to those more professional investors in your pre-seed round, you can execute them all on the platform, get them on your cap table, know exactly what the dilution you're going to be facing if you go and do a priced round after that, because convertible instruments, the math can get a little confusing. And we haven't even talked about stock option plans, but that is, we have a full stock option plan package for when your company grows in value. And this is kind of like what our product looks like. I still think it's beautiful. We have our own signing solution. So things are nice and sweet. You don't have to like set up passwords or things, magic links driven. It's tons of fun. We love Gus Launch. All right. Oh, and we support you. We're doing this event. We do biweekly office hours. We do tons of programming. If anybody's run into Sarah, she's been taking our curriculum and really operationalizing it. So you'll see more of this from us, of our own expertise, of all of our partners. And I just sent out an email for a HubSpot invite or an event we're doing next week. We've done ones with business insurance. We've done ones with tax considerations, with how to do fundraising platform or fundraising process. So being part of the Gust ecosystem alone, all of you are probably here because you've run into Gust at some point and gotten a Gust account. Gust launch gets, the majority of our kind of support attention, but we also just do a ton of programming to try and, lift everybody up in the space so more people can become entrepreneurs and actually have a better shot at success. All right.
And I guess one other thing to know before we move into questions is that we do not think that your entire legal and accounting stack can ever be handled by software. We recognize every startup's going to need a lawyer. What we try to do is minimize the costs and keep a network of experts that we can refer you into when necessary. So we run office hours to basically act as a translation layer, help you understand your questions, and decide whether or not it's time to start paying a billable hour professional for a strategic need. If you do have one, we keep a vetted network of startup lawyers that we refer you into. We keep a network of vetted startup accountants that we refer you into, and we're growing that network all of the time. All right, Nash, I will give you a talk break and I will get through these.
Oh, wonderful.
We're low on time. So if I answer your question and you have more questions, please just throw more questions in the Q&A. First question is from Sarah, who started off using Clerky and asked, is there a smooth transition plan to go off of Clerky to Gust? The answer is maybe. We've worked on some transition plans and we've successfully onboarded a few people, but it really depends how far along you are. If you want to reach out to either Ryan and I, we can help determine that. Okay. Vrinda asked or says that they already incorporated as an S-Corp in California, put the initial shares as 100. Can I change the number of shares available? I'm the sole founder and do not have a board as of yet. So yes, two things. Remember that S-Corp election is just your tax status. That is saying that your California corporation will be taxed as an LLC. And then the answer is yes, you can always change the number of shares available in your company. To do it, you will have to go back to the state that incorporated the company in the first place and file an amendment or an amended and restated certificate of incorporation that will increase the number of shares that you have available. That's actually the process that you go through anytime you sell preferred shares to investors. You go back to the state, you file paperwork to create a new class of shares, and you increase the total number of shares in the company. You can do the same thing for common stock. All right, Larry is already registered with Gust. Haven't registered in home state of New Jersey yet. Just haven't needed to. When should I consider doing this? Nash talked about this a little bit earlier, but you were always weighing your compliance burden with your compliance risk. In terms of foreign registration, you are intended to file as soon as you are doing business. Clear indication of doing business is having a headquarters there, having a W-2 employee there, anything that really roots you there physically. Once you start actually having revenue and customers in the state, you can typically also hit an economic nexus. In the early days, some of those things are a little bit more of a gray area. We do have a nice teardown by a former Gust launch legal partner on how to make the kind of risk reward calculation for Texas foreign registration. Nash, I don't know if you have that handy, but we can have it in the follow-up notes. But generally, startups often defer foreign registration until there is some pushing factor. That pushing factor is often preparing for a funding round or filing taxes and working with an accountant on a yearly basis. So those are two inflection points. Also things like hiring a W-2 employee or opening an office in a state. Okay, next up, what's the difference between stock options and warrants? All right, so both stock options and warrants give somebody the ability to purchase shares of the company at a later point. Stock options are typically issued to employees or other people who are service providers of the company. They can't just be issued to anyone. Stock options give you the right to buy shares in the future at a price that's set at the time of the grant. So that price it will be called the fair market value of the company. If you're issuing options, typically that fair market value is determined by an external valuation. So somebody who doesn't work at the company looks at your finances, funding history, and assets and comes up with a fair valuation. That gives you safe harbor from the IRS so that if you issue stock options at that strike price, which is the fair market value when you issue shares or issue options, then you are safe and the person is safe from any future litigation or assertion that that fair market value is incorrect. But basically the key difference is options lock in a price. Warrants, on the other hand, gives the holder of the warrant the ability to issue some or to purchase some number of shares at a later date. They are often used as kind of a hedge or a way for investors to maintain a percentage, or as kind of an optional investment for somebody at a future date. So warrants would be more frequently used to incentivize business partners or investors. Options are almost exclusively used for employees. Chris asks, vesting implies a stock option plan, does it not? How does one set up a company stock option plan inexpensively and well? So common shares and stock options can both vest. The difference is that common shares have what we call reverse vesting, which means that if I grant a common shares to Ryan, he has and maintains all of the voting rights to those immediately. However, the company retains the right over the vesting schedule to automatically repurchase those shares at the original issuance price, usually, if Ryan's relationship with the company ends. So from a governance and voting standpoint, Ryan has all of the shares as soon as they are granted. But if Ryan is fired from the company can repurchase everything that is not yet vested at the original price without Ryan's consent. The consent is baked into the original agreement. Options, on the other hand, vest the ability to purchase. So when you're granted stock options and none of them have vested, you can't exercise any. You can't exchange that option. You can't actually take that option. You can't turn that option into a share. With stock option vesting, it's just regular vesting. So over time, you have the ability to actually exercise the vested shares, and you can exercise them as soon as they are vested. That is your right. Sometimes companies will allow early exercise, but that's a whole other story. What's the typical volume for preferred shares at pre-seed, seed, Series A? Interesting question. What typically happens at each of these rounds is that you negotiate what's called a valuation with your investors. Usually they are looking at it in terms of, the company needs this much money and we need this percentage of the company ownership for us to make a profit later. And the company is thinking, we need this much money and we are willing to give up this percentage. And then each uses kind of the metrics that are available during diligence to try to argue for their interpretation. So generally what will happen is they will agree on a valuation and they will agree on the amount of money that will change hands at that valuation. And then doing division, that will actually determine the share price. And based on the number of investors coming in, that will determine the number of shares. So it's not really like somebody is saying at the outset, like, oh, this is going to be exactly this number of shares per, but very broadly, companies typically sell somewhere between 10 and 20% of the company at each round. So if you look at the current capitalization of the company directly prior to a funding round, you've got those bounds that you can take 10 to 20% of the total denominator.
Yeah, so you probably see like $1 million and change for the first one, and then that would grow as the overall base grows.
Bridget asks, when shares are issued to a self-directed Roth LLC, should that LLC still file the 83B election? There are a lot of questions wrapped up in this because each LLC is different and an LLC can elect different tax treatment. It is not always entirely clear whether or not an LLC can or should file an 83B. So that's something you probably want to ask an accountant. And just be careful too, because as a founder, you are not necessarily able to capture your shares into a self-directed Roth under an LLC. So beware of that. Nash, you may have already done this, but can we share a reference to QSBS? Awesome.
Yeah, I'll throw our FAQ one in there.
Cool. Carolyn asks, does independent shares come from preferred shares, or they are issued independent of preferred shares? I am not quite sure what you mean by independent shares, so I'm not sure I can answer that one. If you can clarify, let me know, and I will try to. Bridget asks, which GUS plan are the contractor and advisor agreements available under? They are available under GUS Launch Accelerate, which is the second tier, which is $1,000 a year. Paulo Perez asks, all this works for Spain too, or is more specific to US legislation? At a very high level, everything we've touched upon today applies relatively broadly to organization internationally. That said, each place has different specific rules. So while there are a lot of similarities, if you are looking at incorporating in Spain or somewhere else, you'll want to find a service that specializes there. We specialize in forming US entities. Now, often people who are located outside of the US also want to form US entities. So if you're from Spain, you're more than welcome to form a US entity with us. But we do not form entities in Spain or any other foreign locality at this time. Is GUS Launch similar to Carta? Carta tracks shareholders, electronic stock certificates. Is it a new alternative or something you would use in addition to Carta? Cool. So Carta is a cap table management platform and somewhat of an investor relations platform. Carta is typically meant to be used in conjunction with a lawyer. So what will happen is you will work with a lawyer to execute legal documents, and then they will manage your cap table in Carta for you. GUS Launch kind of combines the two concepts with a focus on everything from incorporation to Series A. So when you sign anything on GUS Launch, it is automatically written to your cap table, and you don't have to work with a lawyer to draft those agreements and encode best practices. The agreements for issuing stock and later stock options all come as a package. You have access to those. You put in inputs around vesting and things like that, and everything else is based on best practices. We make sure you actually get board sign off and loop all of that stuff in, and then we automatically write it to a fully transactional digital cap table underneath. So if you're using GUS Launch, you do not necessarily need Carta, although very often once you hit Series B, you may move to a larger cap table management platform at the behest of investors or something like that. Ooh, all right. Can we speak to our why? What made you care enough to do this? So I think we were both convinced to care enough to do this by David Rose, who founded GUST originally. The whole philosophy around this is helping entrepreneurs. Ryan and I both come from individual contribution backgrounds. I did not know any of the nuts and bolts of actually setting up a company when I started computer programming. I thought about it a bunch, was always put off and super intimidated. So working on stuff that lowers that barrier of entry and helps people who wouldn't normally start a company because it was too intimidating or expensive actually get it done and get it done well is something that I'm pretty passionate about. Nash, you want to add anything?
That was actually probably the best off the cuff answer that you've had for that.
Nice.
Yeah, very similarly, always wanted to know how to get started in this realm. I think Pete and I both came from I grew up in upstate New York, always fascinated by side projects, always had 100 side projects that I wanted to turn into something, but it was like beating my head against the wall of like, how does that actually work? And pursued a technical and then a leadership being found GUST actually 10 years ago. And I joined as the CTO, built out the technical team. But then I think Pete and I both kind of fell in love with the solution space and the customer base when it geared towards the founder products that we were building. GUST has a ton of additional tools. We have like a CRM for investor groups, for accelerators through application management. And I think both Pete and I love working on all of those because you're literally trying to build the flywheel between all the players in that earliest stage space. So make it so easy for companies to actually get set up and the right information at the right time so they don't screw things up. And then helping them find accelerators, helping them find angel groups, even help angel groups run better and get more qualified companies. Like the whole ecosystem is incredibly satisfying. And even doing events like this, getting to that aha moment where you really unlock some understanding in this rather counterintuitive world that we exist in is fantastic.
All right, I'm going to jump to chat questions real quick because we had a bunch of those, and then try to get back to the Q&A questions.
Oh, nice.
How does Gust help with compliance? Big question, but we make sure you're actually properly formed and that you actually establish the corporate veil. We remind you about tax obligations like franchise taxes and corporate income tax. We help hook you up with experts, both accountants and lawyers, to navigate those things. We also make sure through the software that you are keeping the correct paper trail when you're doing things. Often in the early stage space, people will sign partial agreements or not get the right approvals or not ever bother to set up a board of directors. So we help you actually manage all of that and get written consents from everybody who needs to consent as you go. And then we also have things like office hours and educational webinars and all of the rest of the content we produce that help you just learn about this stuff and navigate it. Someone paid for contract work, retaining the IP themselves. What's the best way to transfer the IP? First off, if you are contracting work and you want to retain IP yourself, make sure that your contractor agreement covers it. If you're contracting in the US with US-based contractors, by default, they own the IP and you have a perpetual license. So make sure the IP is actually assigned to you. Once you have it, typically when you actually incorporate a company, a startup will have what's called a founder IP assignment, which will help you transfer any existing intellectual property into the company, and also bind you to things like non-disclosure. It's basically a very lightweight employment agreement that does not specify whether you're a contractor or a W-2 employee. There are also just standalone IP assignment agreements that can be used outside of that context. When do I have to file taxes? What forms and payment to be done? Again, big question at a very high level. Startups typically have to worry about 3 different types of taxes. One is just the I'm doing business in your state and you charge me tax, which Delaware has. Other states that you foreign register in may also have yearly or bi-yearly fees just for the pleasure of doing business there. Delaware's is due March 1st. It's either the 1st or 15th. I always forget which, but if you log into Gust Launch, it'll tell you with an actual date. Then you have your corporate income taxes. You have to file those federally and on a state-by-state basis. Typically, startups are investing all of the money they're making back into development, and there's no profit, or they're really just not making any money yet. So most startups will not owe corporate income tax, but you do still have to file. And then you may also have to file at the state level from an income tax perspective. Accountant is the best person to help with that. And then there's your sales tax and things like that, which start applying once you have revenue and are selling into a state. There's usually a threshold. Services like Stripe and other bill payment providers can help you with that and are adding more and more services on top of stuff like that. But generally, that does not matter until you have revenue. And sometimes those taxes overlap with the pleasure of doing business in the state taxes and combine in how they are assessed. Do we have an accountant for incorporation, address for PO Box in US for incorporation process? We do have an accountant that is familiar with working internationally. So that is the support that we have on an accountant person basis if you're incorporating with us. We don't currently provide virtual addresses. If you do plan to use a PO box, watch out. Often banks and for the purposes of like your EIN application, you can't actually use a PO box. So careful there. What is the case for Gust Launch if we choose to build without adding outside equity? It's significantly reduced if you don't plan to have investors, honestly. But if you plan to incentivize employees with shares or stock options, then it can still be pretty compelling because trying to set that up in an LLC is typically kind of unwieldy to manage. But it's definitely a different calculation if you don't plan to raise outside money. In Delaware website, they offer corporation with stock corporation and stock corporation with director's liability. What is better for a sole founder currently raising first round? It's going to depend on your personal situation. You know, we would suggest using a startup focused service rather than going directly through Delaware. Also, somebody is going to need to prep your COI. So there will be different filing services that do that. Our COIs are startup specific. They do offer some provisions around director and officer liability. Typically, as the company grows, you'll get insurance for that stuff as well. And also be careful, especially with Delaware. I think there are about 10 sites that sell different things that all have Delaware in the name. So make sure that you are actually on a .gov website. Otherwise, you are probably on a website of a for-profit company. Okay. We're 5 minutes over. I think we can get through the rest.
Can you turn them off somewhere?
Let's see. Our LLC had a member with an ownership percentage, but that relationship did not work out. When we convert to a C Corp and determine equity, good and fair options for lowering their footprint in our cap table. There are a ton of options, but they are going to have to agree with them. So that is something that you're going to have to work out with them and probably have some sort of agreement drafted in writing so that you can reference back to it to lower their claim. But definitely something you should talk to a lawyer about. Because we are not lawyers and we cannot give you legal advice. Bobby asked if we manage the cap table, and yes, we do manage the cap table. Let's see. What support are in place for using Gust? Oh, are you changing this while I'm going?
I was just clearing out the ones you just answered.
Gotcha. Without intending to raise funds, e.g. self-funded bootstrap. You can totally use it self-funded bootstrap. Again, we are typically in a spot where we are most useful for folks who are leaving the external investment window open. So if you really intend to bootstrap this thing for its entire lifetime and never take outside money, then you probably want to think about whether or not a C Corp is actually the right entity for you. Do we have an investor management tool, viewer analysis, investor share ownership across different issuers? That's an interesting question. I'm not sure exactly how to manage it. We do manage your cap table, so you can see who is invested in all of the different instruments that you have outstanding, and you can model how that will or how that impacts ownership now and potentially in the future. But in terms of looking at it across different issuers, we don't have stuff to bring something in, like if you did, for example, a crowdfunding round on an external platform, we can help you manually reflect that in the cap table, but there's no automatic syncing with other providers right now. Okay, Caroline got back to us. Independent shares are normally for non-investors, non-employees, and non-founders. Interesting. I assume that means they are going to be some sort of non-voting share, but honestly, I'm not familiar enough with them to give you a good answer. Generally, for anything that is so different from preferred shares or common shares, you will likely have a separate class of shares for them because each share class can have different rights and restrictions around it. So it would be logical that those would be done as a separate share class. All right, already created a C Corp with most of the documents you've mentioned. Can those be imported to Gust for future management? Again, it kind of depends, but if you've done all of the stuff that we currently support, it may not be the best platform for you just from a value add perspective. If you've got questions, feel free to email us or reach out via chat on the site, and we can walk through it in more detail. What is the process for adding more stock for an initial co-founder? Can Gust Launch handle this? Yes, can and does. We can do it through either common stock or options, but typically if you're adding a co-founder, you'll probably be doing it with common stock. The process is that you draft a new agreement specifying the number of shares and the vesting schedule. You have your board sign it, you sign it, and then you have the grantee sign it. They get sent 83B paperwork so that they can send it into the IRS and minimize their income tax obligation. And then once everybody signs it and you record payment, it is reflected on the cap table. So we can handle that. The only wrinkle to that is if you have already issued all of your available shares, then you're going to have to go back to the state of Delaware and create more before you can issue to a new co-founder. Different plans and pricing are available on the website, but the 3 tiers we have are $300 a year for basic incorporation and maintenance. That includes your registered agent. Then we have $1,000 a year, which includes the legal network, some more partner perks, and some more legal agreements, including safe and convertible note for $1,000 a year. And then we offer option plan. Oh, it's just up on the screen. Okay.
You know,
thanks, Nash.
got to be valuable somehow.
Okay. Ian, your co-founder likely should not be issued safes unless they are investing money in the company. And if they're being issued safes, they should be investing a lot of money in the company on the order of an investor. That's high level how things usually work. Maybe there's a situation where that would make sense outside of that context. We're just not familiar with it. If you're doing a 2-month trial period before they actually come on, generally you have a couple options, and companies will often bring somebody on as a contractor first for a test period with a grant that matches that time period in that role. And then if it works out, they then elevate them to a co-founder and create a new stock grant associated with that role. Other options that we have seen in the market is to, if you are sure about this person, you can have your vesting cliff mapped to the trial period. You probably want it to be longer than 2 months. Typical trial period for a co-founder is a year, if not more. But as long as the relationship ends prior to the vesting cliff, the company can very easily recoup all that shares and it doesn't become dead equity. Okay. Once incorporated on Gus, will we help founders at all times, or will the fees change, additional fees? How easy is it to contact Gus and get replies? We keep a pretty tight SLA on our chat level support. We've got experts there. We've also got biweekly office hours, so you are never more than 2 weeks away from being able to yell at us and talk to us directly. Okay. All right, and last one, I think. There's probably more in chat that I'm missing. When you mention firing a co-founder, does it mean by the votes majority of the co-founders left? Oh, so it depends on how your company is set up and your bylaws and the power that's vested in the different officers of the company. Typically, the CEO and president of the company have pretty broad latitude to fire and hire at will. As long as that is the case, then firing a co-founder is simply a matter of documenting that in writing and then triggering the provisions. But if you're not sure how your bylaws are set up, it's best to work with a lawyer to understand exactly what your rights and obligations are.
Okay. And Bridget has validated us that our chat turnaround on the site has been really good. Sounds like Bridget's a customer. Oh yeah, Bridget Bell. Nice to see you again. All right, did you clear through the Q&A or did you stop? Because I still
cleared through the Q&A.
Oh, okay. All right.
I think I got them all. Or most. Oh, maybe not.
No, I think there's some up top. We had a couple questions. If you've already kind of done most of this, is there much value proposition left? I think Pete covered like the formation stuff. It's very expensive to kind of bolt on the functionality that we have. So we only do it on a case-by-case basis for already incorporated entities. A lot of questions on transition. I got some in the chat. I think the biggest thing is if the purpose of the LLC was the business activities that you wanted to pursue now with the C Corp and not much was done and you're the only person that owns it, usually dissolving is the more straightforward, cheaper way and just kind of starting over because it's all you. If you've done anything else, like you brought on other people, you have revenue, IP, whatever business activities, you'll probably want to consider a merger or a statutory conversion, which means you'll probably want to work with a lawyer to get those stuff in order. It doesn't mean you can't work with launch if you do decide specifically to do a statutory conversion after you purchase launch, but before you file the Delaware C Corp, it's at the end of the first workflow. Just reach out to our support and be like, hey, I'm doing a statutory conversion. We'll ask you for the documents. There's like a plan that you need that we will file with the Delaware C Corp. And then it's kind of business as usual after that.
Yeah, I just posted a blog post in the chat that goes into that in more detail.
Oh, yeah, that's good.
But especially if you have employees or anything like that, you're going to want to carefully consider this, especially in terms of time of year and tax obligations. So, if really your LLC is nothing, fine. But if it's anything more than nothing, you'll probably have to talk to some folks.
Hey, did you get Chris's here about, have you seen a situation where things were so confused or constrained, it was much easier to abandon the faulty C Corp and start a new one, right? Haha.
I mean, we have seen people choose that option, but I don't know that I have seen a situation where I personally would think that was the right option. So it is really tough to say, because if it's worth going through the process of like transitioning it, and the same people and like contracts and IP are going to be involved, then when you talk about fixing things versus shutting them down and restarting, the conversation just gets messy, and there's just a lot of things that you have to consider. So it's not an easily answerable one, but we've definitely seen it done.
Yeah, I think the the biggest thing I always harp on is it's not like any of these things are automatically going to just cause effects. So like if you left a dormant company, just let it go out to pasture and you didn't do anything with it and you started over, it's not like Delaware is going to show up at your door and be like, hey, what have you been doing with that dormant company? I think those activities in that other company you started are actually like most state bodies won't actually bother with that stuff. It's really, this is the United States. All things change based on lawsuits and litigation. So if there's a reasonable feeling that like if you don't clean things up with an existing entity and there's other players involved and they would have the desire to make a case against you, leaving things messy just gives more potential rounds of evidence, but things would eventually fundamentally be decided in court. So often, like if there's those kind of relationships and you want to be sure that everybody is aligned with what's going forward, it's worth the cost to make sure it works. But if it's something like you just filed a Z corporation, you messed it all up, it's messed up, but nobody else cares about it or knows about it, unless you're going to sue yourself, which does happen. We have found some interesting cases, not in C Corps, but in US law where people have sued themselves. Sometimes you can be like, oh, I'm fine just trashing this whole thing and just redoing it. But anywhere in between.
I think that is the good point, right? Fixing it and correcting it is not necessarily easier sticking with the same entity or forming a new one. The level of ease is how many people you have to talk to and how many people you need to get affirmative consent from. Because if you do it wrong or try to take shortcuts, it still leaves the doors open for the people that you've wronged to come back and assert that you have wronged them from a legal and financial standpoint.
I'm going to get a link for Laura about the event we did on crowdfunding.
Yep. But yeah, at a high level, if you're going to crowdfund, you'll typically do it through a crowdfunding platform. In fact, you have to some extent to comply with the regulations. So they will typically work through all of the SEC compliance and filings and all of those things. And then we'll also handle the close of the raise so that they can take their percentage cut, which is how they typically make money. And then once all of that has closed, typically you will then move that information back to your canonical cap table provider. Some of them will also offer like cap table solutions as an add-on service.
All right, I've got 7 left in the Q&A. Is that the same thing you see?
Yeah, but some of these were duplicates with the ones I answered by
Gotcha.
pulling them over into notes because they were duplicated in chat. So I think we're all right. If anybody who is still here has a question that we haven't answered, feel free to plop it in the chat or the Q&A, and we'll get to it before we break.
Oh, I think we're good.
All right.
Not too bad. 20 minutes over with a detailed Q&A. All right. Well, thank you for coming. I think we had about over 100 people in here, and thanks for the half of you that stuck it out to the end. Be on the lookout for more programming. Like Pete said in the beginning, this is part of our launch curriculum. We are going to run curriculums throughout the year about, startups at every stage, or probably at the most interesting stage is the 0 to maybe 100. And there'll be more programming coming from us and our partners, more events like this, more opportunities to get in touch with the team and just kind of expand. A lot of times you got to hear this stuff several times from several different angles before the whole thing kind of becomes more cohesive and it makes sense. We'll send a follow-up tomorrow. It'll have the recording and probably a bunch of the stuff that we've talked about, or at least as much of it as we can remember. And as always, thanks for coming. Pete, thank you for taking over the Q&A.
Yeah, thanks for running the
answering all
event.
those questions.
And yeah, if any of you have other stuff that you'd like us to address in like our content or webinars, please feel free to reach out and make suggestions. We've got a pretty good perspective on what's confusing, but we certainly don't know all of it. So if there's something we're missing, let us know.
Awesome. Thanks again, Pete. Have a great week, everybody. See you at the
Thanks,
next
Ryan.
one.
Thanks all.